Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. Just disclaimer, house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified daily trade analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elliott wave theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the official bank rate, second one is the unemployment rate Canada. What is official bank rate in UK? The official bank rate is the interest rate set by the Bank of England and serves as the primary tool for controlling inflation and economic stability in the United Kingdom. Changes in the bank rate directly influence borrowing costs, consumer spending, and overall economic activity. While a higher than expected rate or hawkish outlook usually supports the British pound, a neutral or dovish tone can weaken the currency and increase volatility in GBPUSD currency pair. Now, if you look at the number, the previous number was 3.75, forecast was also 3.75, and the actual number came out is also 3.75%. The Bank of England kept the official bank rate unchanged at 0.75% in line with market expectations. Despite no change in the headline rate, GBPUSD moved lower following the release, indicating that traders reacted more to the tone of statement than the decision itself. Let me show you the chart of GBPUSD currency pair. Here's the daily time frame. So right over here, the news came out and the pound dollar actually dropped. As of today, it's moving back up. Although inflation remains above long-term targets, the bank's communication reflected growing concerns about slowing economic growth and weakening consumer demand. This cautious stance reduced expectations for future rate hikes and shifted market sentiment against the British pound. Now, most people might ask why the GBPUSD currency pair moved down. Even with rates held steady, the overall guidance was perceived as neutral to dovish. The lack of strong commitment towards further tightening disappointed bullish GBP expectations. The key factors behind the downside move includes reduced confidence in near-term rate hikes, emphasis on economic slowdown risks in United Kingdom, softer forward guidance on inflation control. As a result, selling pressure increased on the British pound, pushing GBPUSD lower after the announcement. The key market drivers to observe are the rate decision matching expectations, tone of the Bank of England statement, cautious outlook on growth and demand, inflation moderation signals, broader US dollar strength, and risk sentiment. The technical and sentiment considerations are post-release price action, confirmed bearish sentiment in GBPUSD pair. The move lower suggested that the forex traders were positioned for a more hawkish signal and adjusted quickly once that failed to materialize. Liquidity around the announcement amplified the move, leading to fast downside momentum and limited immediate recovery. As far as the trading outlook is concerned, the downside pressure remains dominant unless sentiment shifts. Further moves will depend on follow-up data and Bank of England commentary. US dollar strength continue to influence market direction, and volatility may persist in the near term. So the risk management remains critical. The overall analysis and the key takeaway is although the Bank of England delivered no surprise in the interest rate decision, the market reaction was clearly bearish for British pound. The absence of hawkish guidance and growing concern over economic growth led forex traders to sell the pound, resulting in a downward move in GBPUSD currency pair. This event reinforces the importance of central bank guidance over headline numbers. The final key takeaway is rates were held at 3.75% as expected. GBPUSD moved lower due to neutral to dovish guidance. Forex traders should focus less on the rate itself and more on future policy signals, as sentiment and expectations continue to drive directional moves in the British pound. The next macroeconomic event is the unemployment rate in Canada, and we're going to discuss the USD CAD currency pair. Now, what is unemployment rate in Canada? The unemployment rate measures the percentage of the total labor force in Canada that is actively seeking employment but unable to find work. It is a key indicator of economic health and labor market conditions. A lower than expected employment rate generally supports the CAD and can push USD CAD lower, while a higher reading signals economic weakness and may drive USD CAD higher, often increasing short term market volatility. The previous number was 6.8%, forecast was also 6.8%, and the actual number came out at 6.5%. Canada's unemployment rate came in the lower than expected at 6.5%, signaling a stronger and more resilient labor market than market had anticipated. This positive surprise supported the Canadian dollar immediately after the release. As a result, USD CAD moved lower, reflecting increased demand for CAD and reduced expectations for near-term easing by the Bank of Canada. Now, why USD CAD moved lower? Well, let's take a look at the chart of USD CAD currency pair. So over here, the news came out, and after that, we got a big drop in price action of USD CAD currency pair. Well, the USD CAD moved down because the stronger labor market reading reinforced the confidence in Canada's economic stability and reduced downside risk for the Canadian dollar. The key drivers behind the move included unemployment falling below forecast and previous levels, uh, improved labor market resilience, reduced pressure on the Bank of Canada to cut interest rates, positive sentiment towards CAD relative to US dollar. So this combination led to selling pressure on USD CAD following the announcement. The key market drivers to observe are the unemployment rate beating expectations, labor market strength signals, Bank of Canada policy outlook, crude oil price influence on CAD, overall US dollar sentiment. Canadian labor data remains highly influential due to its direct impact on monetary policy expectations. Technical and sentiment considerations are post-release price action confirmed bearish momentum in USD CAD with sellers gaining control shortly after the data release. Forex liquidity conditions around the announcement amplified the downside move, and momentum indicators favored CAD strength as traders adjusted positioning to reflect improved employment employment conditions. The downside bias remains while CAD strength persists. That's the trading outlook. Further movement will depend on follow-up economic data. US dollar trends remain an important secondary driver, and volatility may continue in the short term. So, risk management remains essential. The overall analysis and key takeaway is the lower than expected unemployment rate delivered a clear bullish signal for the Canadian dollar even without additional surprises. The improvement in labor market conditions was enough to push USD CAD lower. This release highlights how positive labor data can drive CAD strength even in uncertain global conditions. The final key takeaway is the Canada's unemployment rate fell to 6.5%, beating expectations. USD CAD moved lower as CAD strengthened on improved labor data. Forex traders should continue monitoring Canadian employment trends and Bank of Canada expectations as labor market strength remains a key driver of USD CAD direction. Now, let us take a look at previous week global market trends. The first one is the euro dollar, then we have the US dollar Swiss franc. As far as the US dollar is concerned, it seems to me we have seen a top over here. If I zoom in a little bit, this is the weekly time frame. We got this ugly looking candlestick over here and a long spike in price action. In daily time frame, we got a big washout to the downside over here. And this thing suggests that price action of euro dollar is probably going to drop further. Next one is the euro dollar 4-hour time frame. This is where we got this bearish trend channel breakout. So it's quite possible that euro dollar is probably going to move sideways and then expect further weakness in price action of euro USD currency pair. Next, US dollar Swiss franc. The overall trend is still down in US dollar CHF currency pair. If you take a look at a daily time frame, you got this bullish rally, but it's possible that market wants to drop more and then probably prints a bottom. So it's possible that price action is going to drop first and then uh, expect a bullish leg in US dollar Swiss franc currency pair. So USDCHF, the price action is, it looks quite bearish. So expect a drop in market first, and then USDCHF is probably going to rise up again. Next, let me talk about the current week's macroeconomic events and data releases. I will be covering the key developments in Forex market with a focus on fundamental analysis. The first one is the GDP month over month related to United Kingdom, and we are going to focus on GBPUSD currency pair. The next news announcement is the trade balance related to Europe, related to Eurozone, and we're going to discuss the euro dollar currency pair. Let's start with the first one. GDP M or M related to United Kingdom. Now, what is GDP M over M? GDP M over M measures the month-to-month change in the total value of goods and services produced in the United Kingdom, reflecting short-term economic performance. A stronger than expected reading usually supports the GDP and can push GBPUSD higher as it signals economic expansion and improving business activity. A weaker than expected figure may pressure the British pound and drive the GBPUSD to the downside. And you might see increasing market volatility and downside risk. Now, on coming February 12th at 7 a.m. UTC time, the GDP in United Kingdom is figure. It's going to be released. So, as far as the previous number is concerned, the previous number was 0.3%. Forecast is 0.1%. The actual data is going to be released on February 12th, 2026. UK GDP data remains a critical driver of pound sentiment, especially in the current environment where the growth concerns and monetary policy expectations are closely linked. Recent data suggests the UK economy is losing momentum with slower consumer spending and softer business activity weighing on growth. The forecast points to a sharp slowdown from the previous month, increasing market sensitivity to any deviation from expectations. Forex traders are positioning cautiously ahead of the financial data release, aware that even a small surprise could trigger a strong reaction in the GBPUSD currency pair. Now, the market expectations and different scenarios. Let's discuss that. If the GDP month-over-month prints above 0.1%, this would signal better than expected economic resilience. GDP could strengthen as growth concerns ease, potentially pushing GBP/USD currency pair to the upside. If the GDP month-over-month data comes out at 0.1%, this would meet expectations, meaning it meets the forecast and confirms slowing but stable growth. Forex market reaction may be muted, with GBP USD direction influenced more by US dollar strength and broader management risk sentiment. If GDP month over month prints below 0.1% or turns negative, that number would raise concerns about economic stagnation or contraction. GDP may weaken as expectations for accommodative policy increase, potentially driving GBP USD lower. The key drivers to watch is the deviation from forecast and previous GDP reading, signs of economic slowdown or resilience, implications for Bank of England policy expectations, broader US dollar direction, and global risk sentiment. The GDP data often acts as a confirmation or warning signal for broader economic trends, making it highly relevant for short-term trading decisions in the forex market. The tactical and sentiment considerations. Uh, the price action of GBPUSD pair ahead of the release reflects cautious sentiment. Let me show you the chart of GBPUSD currency pair as well. This is the daily time frame of GBPUSD currency pair. So we got this breakdown in market, a nice bearish leg, and now market is trying to rise back up over here. False breakouts and rapid reversals are common during GDP releases, requiring disciplined trade management. The trading outlook is to expect elevated volatility around the financial news release time, and that time is 7 a.m. UTC time on February 12th. Directional moves will depend on the size of the GDP surprise. Follow through may require confirmation from subsequent data. Wider spreads and fast price movements, we are probably going to see that thing. So strict risk management is advised. Overall analysis and the key takeaway is the upcoming UK GDP month over month release is expected to show growth at 0.1%, reinforcing concerns about the weakening economic momentum. With growth already under scrutiny, the forex market response will depend heavily on whether the data confirms or challenges this slowdown narrative. Any upside or downside surprise could quickly shift market sentiment and drive significant movement in GBPUSD currency pair. The final key takeaway is forex market expects UK growth to slow sharply this month. So GBP/USD pair reaction will hinge on whether GDP beats or misses market expectations. Forex traders should be prepared for volatility and closely monitor price behavior immediately after the news release to confirm direction. The next important news announcement is the trade balance in Europe, and we're going to focus on euro dollar currency pair. Now, what is the trade balance? The trade balance measures the difference between exports and imports across the Eurozone. So, across the Eurozone and reflects the region's external economic strength. It shows whether Europe is earning more from exports than it spends on imports, which can influence demand for the euro. A higher than expected trade surplus typically supports the euro and can push euro USD higher, while a weaker balance or trade deficit tends to pressure the euro and may drive euro USD lower, often increasing market volatility. The previous trade balance number was 10.7 billion, forecast is 11.8 billion. The actual figure is going to be released on February 13 at 10 a.m. UTC. Eurozone data remains an important indicator of external demand and currency flows in the euro. The global trade conditions still influenced by fluctuating energy costs and uneven economic growth. Forex markets are closely watching whether Europe's export sector continues to show resilience. The the forecast points to an improvement in the trade surplus compared to the previous reading. This raises expectations for supported euro flows while also increasing sensitivity to any downside surprise. If the trade balance prints above 11.8 billion, this would indicate stronger export performance and improved external demand. Euro could strengthen, potentially pushing Euro USD to the upside. If the trade balance prints near 11.8 billion, this would confirm steady trade conditions. Forex market reaction may be limited, with Euro USD direction driven more to the US dollar strength and overall risk sentiment. If the trade balance prints below 11.8 billion or shows a deficit, this would suggest weaker external demand or higher import costs. Euro may come under pressure, potentially driving Euro USD to the downside. The key market drivers to watch is the deviation from forecasts in previous reading, export and import trends within the Eurozone, impact of energy prices on trade flows, European economic growth expectations, overall US dollar direction, and global risk sentiment. Trade balance data can influence medium term currency flows, particularly when it diverges from expectations. Technical and sentiment considerations are euro dollar price action ahead of release reflects cautious positioning, with traders waiting for confirmation from the data. Volatility may increase around the release, especially if the trade balance delivers a meaningful surprise. Short term price spikes are common during data releases, highlighting the importance of execution and risk control. The trading outlook pre release is the increased volatility expected around the news time. Directional bias will depend on the size of the data surprise. Follow through moves may require confirmation from broader forex market sentiment. Wider spreads and fast movements are likely going to happen. So a good idea is to use strict risk management to control risk. The overall analysis and the key takeaway is the upcoming Eurozone trade balance release is expected to show an improved surplus at 11.8 billion. With expectations already leaning positive, the euro reaction will depend on whether the data confirms this improvement or disappoints. Any significant deviation could quickly shift the balance and cause euro USD to disappear. The final key takeaway is Forex market expects an improvement in Euro's trade surplus. Euro USD reaction will depend on whether the data beats or misses the expectations. So Forex traders should stay alert around the release time and monitor price behavior closely to assess follow through directions. Let us take a look at current week global market trends. First one is the euro dollar, then we have the GBPUSD currency pair. Okay, Euro USD, like I've said before, it seems to me Euro dollar is trying to print a top over here. We got this long spike inside weekly time frame. And regarding the daily time frame, Euro dollar actually dropped over here. That's a 2.64% decline. In other words, in terms of number of pips, it's about uh, 262 pips. drop over here, then market tries to rally back up over here. So the way I see, it's quite possible that Euro USD currency pair is probably going to resume the downtrend over here. Next one is the GBPUSD currency pair. GBPUSD currency pair, if you take a look at a weekly time frame, we got this spike over here, right over here, and this whole thing could possibly turn into a double top classic chart pattern. So it's quite possible that GBPUSD currency pair is probably going to drop over here from this area. Now, if you go over to the 4-hour time frame, we got this nice drop in the market, and there comes a pullback. So it's quite possible that GBP USD currency pair is probably going to rise up more and then expect a drop in price action. So the way I see, the pound dollar is probably going to rise up first and then expect further weakness in the market.